The world right now is operating with fear over facts.
Historically, housing doesn't bust.
89% of the country has a 5% or less on their mortgage. We also know that around 30% mortgages in the United States are free and clear.
When mortgage rates dip, mortgage applications go up through the roof.
Significantly.
If you look at what's going to cause a bust, right, it's either going to be...
Welcome back to the What You More podcast. I'm your host, Quinton Harris, and today I'm sitting down with one of my standing co-hosts, Daniel Halvorsen. Daniel, thanks for joining us today, man. It's great to have you on the show.
Yeah, man.
Yeah, so on this episode, you got two real estate professionals right now. We're about to have some just kind of real talk about what's going on right now in the industry, but also just a lot of questions that I think you can really answer. Like, the cool thing I love about this is that you've got two people right now, combined total of 45 years in the industry, over 10,000 closed loans amongst the two of us at this table. Easily more than, a lot of the people I'm seeing on YouTube talk and a lot of people I'm seeing online talk. And it's just, it's hard for me to understand some of the negativity that's out there. And we talk to people all the time and it's like, you don't know how to overcome it. And not only that, it's like, it's overwhelming, right? And it's hard to sift through what's real, what's not real. I had a good real estate agent of ours tell us that the problem is the world right now is operating with fear over facts. And he's like, it should be the other way around. I love that. Facts over fear. So that's what you're bringing to the table today. And that's what I love here. So, a little bit about Daniel as we kind of get started here. One of the things about this show, the reason we created this show was that we really wanted to create clarity. We wanted to cut through the minutia of the media and the online traffic and all the other stuff. And bringing someone like you to this show does that because, you've been originating for 12, 13 years. You've been top at your game for almost every year you've been in the business. And I think you hold the record of number of loans done in a particular county or circle of counties in 1 year. It's pretty impressive. And then you continue to keep rising and elevating your game and helping build people around you, man. So bringing someone like you to this show who has ground level experience as well as all this industry knowledge, man, it's great for our audience and it's really going to be good for our listeners today. So again, thanks for being on the show.
I hope to live up to the hype.
Yeah, man, it's already there. Yeah, I appreciate it. So, one of the things I wanted to tackle to kick off the show was, hey, listen, what's up with all of this notion about this housing boom versus housing bust? Like, we just did an episode on there's $17 trillion. I believe the last time you were on the show, you made that comment that there's $17 trillion of equity amongst the American public right now. Boy, did we tap a nerve when we released that. You had all kinds of people come online talking about there's a crash, it's coming, your margin to equity. And it was all this hysteria. And then you had people rise to the commentary wins that were like, oh, no, like I literally have bought a home and I've made a lot of money in my equity and there's not a home for sale anywhere within a 5 neighborhood radius of mine. And so, like, what's your take on right now this idea that there's homes for sale everywhere and they're just being inventories rising and that this particular bust or this 2008 cycle is going to happen again? I'd love to hear your comments.
Yeah, I can't speak to every market. I'm not boots on the ground in every market in the country. I can only be boots on the ground in the market here.
Fair enough.
But there's also nationwide data from a number of different sources that would suggest that there's no surplus of inventory if you zoom out, right? If you are looking at one particular zip code or one particular community, I'm sure you can find an area where there's a lot more inventory than another particular area, right? Mm-hmm. But if you zoom out and say, okay, I'm zooming out at Northeast Florida, the data would suggest that there's not a lot of inventory out there, especially of homes that are particularly desirable, right?
Ooh, that's a good word.
So I don't think that you can point to the market as a whole and say, there's a lot of inventory coming or prices are dropping, right? Could prices be dropping in one particular area? Sure, of course.
Yeah, there's always like a microscope. If you want to find it, you're going to find it, but that doesn't represent everything that's going on right now.
Yeah, and if you want better context, zoom out, right? Look at a larger picture, right? And there's a shortage of inventory. There's no doubt about that, right?
Right.
A balanced market is 6 months. They actually have, there's a lot of people essentially saying that because there's so little inventory that a balanced market is 4 months now. And we're still not even at that, right? They moved the goalpost to, with 2/3 of the inventory is 4 months is a balanced market. We're not even at that, right? So, and there's these notions that, the institutional investors have all this real estate, right? Which once again, if you zoom out, they really don't.
Do you recall like what that percentage is? It's less than what? It's less than 10%. Do you remember?
For sure. No, I don't. I mean,
I think it's like 7. I think it's less than 7. I think it's like 6.8, but I think it's 7 to your point.
So, you zoom out, there's not this surplus of inventory of institutional investors that have quote unquote gobbled up all the homes.
Right.
The folks saying, oh, well, the Airbnb folks, that's going to cause a bust. Well, that hasn't happened. And once again, there's not enough inventory. If every person in the country that had an Airbnb listed their home for sale today on a macro scale, it's just not that much inventory. So if you look at what's going to cause a bust, right, it's either going to be the primary reason you're going to have a bust is because you're going to have a significant amount of inventory that is going to flood the market and cause prices to drop. If you're looking at what a bust would be, which there's nothing that would indicate that's going to happen. There's not this significant surplus of building inventory that's coming. In fact, that's an area that, quite frankly, they're not building enough. And that's been the case since 2008, since the last, what was a housing bust.
Right.
I think a lot of it is really just the speculation of people have a stock market mindset to real estate. And they say, okay, well, stock market corrections happen all the time, right? So if prices have gone up, at some point there's got to be some correction and prices have to go down 20%. History says prices have gone down 7 years out of 81 or 82 years that they've measured it. 5 of those were the Great Recession, which was a housing bubble, right? And we could spend an entire episode on all of the reasons why the dynamics of this market are not similar to that market at all. But there's really just, historically, housing doesn't bust.
Right.
And there's a lack of inventory from a nationwide perspective. So to think that there's going to be something that would cause prices to drop dramatically, I think that's also kind of been disproven by interest rates have been elevated for 2 years now, and especially elevated for about a year and a half of that, and home prices have gone up. And you can say, well, not in my neighborhood, and well, maybe you're right, but look at the nationwide data. I mean, these companies, Black Knight and CoreLogic and all these different data sources, all of these data aggregators, like they're all coming up to kind of the same conclusion. So there's just no data to support that, is kind of the answer that I would give to that.
Yeah. Now, do you think a lot of this noise, let's call it that, do you think a lot of this noise about a housing bubble is this coming from homeowners, or is this coming from people that don't own homes that are like, if I say it, I can will it? If I keep spewing this, at some point we can get it there. I'm like, this is not GameStop. Like, you can't unite on real estate and get it to bust, right? So, to me, it lends the notion that, you're a homeowner, I'm a homeowner. There's no way I'm going to, preach that. I don't want to see that. So it leads me to believe by default that most of the people who are saying this don't own a home right now.
Right.
Would you agree with that, or how would you assess that?
Well, as somebody that invests on a small scale in real estate, I certainly would love for prices to go down 20% and, selfishly buy more real estate.
Okay.
Do I think that's going to happen? No, which is why I've still bought real estate at elevated interest rates. I've bought multiple properties at current interest rates. So I'm not out here telling people to buy homes and then secretly saying, I'm going to wait for rates to come down.
Yeah.
So, I think that if you don't own a home, you certainly want housing prices to go down 20% because that makes for a really good entry point for you. The reality is the truth is probably that you're buying at the peak of what housing prices are going to be today, but you're not buying at the peak of what housing prices will be in 2, 3, 4, 5 years. So, yeah, sure. The people that are preaching bust are probably a lot of people that maybe wish they would have bought in 2018, 19, 20, 21, 22,
totally,
or 6 months ago. Right. And at this point, they feel like, well, at this point, I might as well wait for something bad to happen because I've already missed this window of opportunity. When in all actuality, if you take from this point to 2 years from now, there's going to be people in 2 years saying, well, I really missed that opportunity despite prices being at what is a peak right now and interest rates being elevated. It's kind of one of those things where we just continue to set new peaks.
Well, and real estate is one of those, if you look at the trend over the last 40 years, I think you go back 6 years, every year presents a new peak, right? Even with the Great Depression going on there, the real estate depression, if you may, it still presented new peaks after that. And so if you were to draw a 4% trend line, we're actually under that. We still haven't got back to the 4% compounding trend line that we would, that's a conservative number. So I guess there's more room to go to get back to that trend line. And, to your point, people who bought in 22 or 21 that thought they were buying in a peak, they're happy with their price right now.
100%.
They're happy with their purchase, right? And that's why you say 2 years from now, there's gonna be people that are like, oh, I should have bought then. It was a peak. But I think there is this notion of affordability issues, right? And I do agree at some point. Like, listen, income is X, and it can only support so much. But if these home prices keep rising, it's like, am I getting priced out of the market, creating this? It is creating this discouragement, right? You tried to buy early on, you missed out on multiple offers, you got locked up in a lease, then you had to go hit the repeat button again a year later. Oh, and home prices jumped again, to our point we just said. There's this discouraging notion that's like, am I ever going to get a home? And the answer is yes, but you probably have to change your strategy a little bit. And one of the things that I love that you present are different strategies. And I know you've got a really cool one to talk about here in a minute, but like, I think what you're about to talk about helps that new homeowner. And I think it provides a potential solution to kind of help fill that affordability gap.
Well, we know, the naysayers will say the data's wrong, but we know that about 50% of transactions right now are first-time home buyers, which makes sense. Facts. Because if you already own a home at a 3% interest rate, your motivation level is probably not quite as high as somebody that doesn't own a home and sees the value in owning a home. But, this Hometown Heroes program that's available here in all of Florida, it's a really great opportunity for first-time homebuyers to get into the game. And obviously can't help home prices being elevated. You can't help, mortgage payments being elevated, but it does help from the standpoint of, I just don't have the money to do this right now. Right. In that, the Hometown Heroes program, for most people, is going to pay their entire down payment, and it's going to cover about half their closing costs. In the form of a second mortgage. So you're going to purchase that home. You have a second mortgage that at some point has to be repaid, whether you purchase or whether you sell or whether you refinance the property, rather. But it's a really good entry point in that it really helps to solve the dilemma of, I want to buy a home, but I don't have the cash savings, but I have the ability to make the payments from a monthly payment perspective. So and the nice thing about that program is if you live in Florida and you work for a company that you report to an office in Florida, even if you work remotely, if you report to a Florida office, then you qualify. So there's no, the Hometown Heroes name was originally named that way because it was restricted to certain professions. Right. But now it's open to anyone and everyone that meets those basic criteria of being full-time employed in Florida, essentially, more or less.
So like every state has some sort of what we call down payment assistance program. And, if you're listening to this and you don't live in the state of Florida, like, guys, there's programs available, and take advantage of that. And a first-time home buyer is defined as someone that hasn't owned a home in the last 3 years, right? So if you haven't had ownership in the last 3 years, you are defined as a first-time home buyer if you're re-entering the market.
And a lot of times it's haven't owned a primary residence in the last 3 years. Yeah. So you could even have owned a home in the last 3 years as long as it was not your primary residence.
There you go. So you learn something every day.
Yep. And a lot of other states have some very favorable programs where they're not repayable second mortgages, or they're forgiven over time. There's lottery systems where it's literally free money. There's a lot of different programs out there. So yes, if you're listening to this and you're not in Florida, you should absolutely explore. I would venture to say most states probably have some type of a housing agency where some type of program like this is available.
And guys, you can we'll put this in our link on YouTube at our channel at What's Your One More. E-Housing, that is like the place you want to go to find out what your housing agency is. It's E-Housing, guys. That's going to be our YouTube channel. Like, go look this stuff up, stuff we can help you with. And by the way, like, hey, if you're listening to this and you're thinking, oh man, these guys can only do, stuff in Florida, guys, you have a loan, any type of loan scenario, like, we can get you to the right place to help you with that loan. You're looking to buy a property, you don't even know where to start, you don't know which agent to reach to, same thing, we can help you with that. Like, that's what we're here for. We can help with these types of things. We are well connected across the United States to help with those types of options and questions that you have. But back to this, specifically here in Florida here, the cool thing about this is, I read somewhere it's just almost up to $35,000 you can get towards down payment and closing costs. The government's going to give you. This gets missed. The news doesn't talk about this. This doesn't get published real well. And then you get these rogue LOs that get out there and they're like, oh man, they got this program, but it's only going to be good for 53 days. And then after that, it's all gone. And it's like, what? I didn't read that in the guidelines. Where's that come from? And matter of fact, we talked to the director, the guy that's running this program, and he's like, man, we got enough funding to last through the end of the year. Like, I don't know why someone would be yelling 53 days. So you want to shed some light on the details about this and why it would benefit and everything about the program real quick?
Yeah, it's $100 million in funding. Last year, that got us pretty much through the end of the year, and then there was some trickle down of funds from transactions that didn't end up closing that ended up being able to take advantage of that. So really, buyers up until probably spring of this year, we're able to use those funds. But it is capped at $35,000. It's 5% of the loan amount, capped at $35,000. And, really it's just got one person that's on the loan has to work for a full-time Florida-based employer. And the income limits go up to 150% of the area's median income.
Yeah, and that's always a caveat. People always go, "Oh, yeah, but it's an income issue." Like, this is pretty big income. They're allowing for larger incomes because if you do, I'm not a quick mathematician here, but 5 times 700,000 is 35,000. So they're going to let you buy a $700,000 home, is what you're trying to say.
Yeah,
here.
the income limits oftentimes are the biggest obstacle to the down payment assistance programs because people make too much money for those programs. But in this case, 150% of the area median income for us is about almost $150,000 per year, and that's
the highest.
And that's per applicant. So if as a household you make more than that, you could still just use one person to qualify for the loan. There's a lot of flexibility within that where you could actually be a household that makes more money than that and still qualify. So it really is very flexible and allows a lot more people to be able to take advantage.
Well, I think it's something that people, just to point out here, like Florida Housing, their directive is to help people getting homes. So they do a lot of favorable things. One of them is the interest rate. I've noticed on this program, traditionally speaking, is pretty aggressive for the market, especially on the government side of the loans. And so, it's also my understanding these rates are preset. It's not like if you went to lender ABC, bank ABC, they're all the same rate. So the cool part about this for the consumer is there's no rate shopping involved, right? Everything's the same. The only difference is service levels and knowledge. And, this is a really important thing because these are those types of programs where, like, if you're going with a lender that just got involved and just started doing this, there's going to be some natural errors that take place. You're going to want to be patient, or you're going to want to go to someone that's really good at this and does it a lot, and this is kind of like their wheelhouse. So keep that in mind as you're kind of going around and looking at this, because that could be the make or break in this loan for you.
Yeah, no, without a doubt.
So, hey, as we get away from first-time home buyers, like, what do you think about you mentioned lock-in effect earlier, and I heard that, and I'm like, yeah, it's like kind of like when you ask your dog to go outside and their ears jump up and they look at you. I heard that, and the same thing, my ears popped up. I was like, oh, lock-in effect. Great opportunity to talk about this. So, hey, we got people. We know that 89% of the country has a 5% or less handle on their mortgage. We also know that around 30% mortgages in the United States are free and clear. Like, for the first time on record, we have a lot of free and clear properties. What are some tactics right now while rates are they're not elevated? They started to come down, which is a good thing, but they're still a little higher than I think that lock-in group wants to, see to unlock. So 2 questions here. First, what do you think the interest rate needs to get to for that lock-in effect to start to kind of unwind a little bit, start to see some inventory come unreleased out of that or refinances happen? And then what are some strategies that these homeowners could use to maybe buy another property or potentially, lower their monthly payment?
Well, I definitely think that the question of what do rates need to be is situational, right? It very much depends on the particular person or household. But, it's funny, the longer that rates have remained elevated, I think that the rate that would get people to move has gone up, right? So when rates first started to go up from 3 to 5, I think people say, well, I need to get back in the 4s for me to do something. Then they went from 5 to 6, and they said, man, if I could get 5, that'd be pretty cool. And, then they went up to 7, 8%. I think that if you were somewhere closer to 6%, you'd probably have a ton more activity. And I justify that in saying that when mortgage rates dip, mortgage applications go up through the roof.
Significantly.
So the consumers tend to be suggesting that something closer to 6% would get a lot of people interested. And, at that point, those people maybe would even have the option to be able to buy the interest rate down into the 5s. So you're talking about interest rates in the 5s with a lot of homeowners sitting on a lot of equity where they could put a sizable down payment down on another home. I think that if rates were, 6 to 5.5 to 6 1/4, you're going to see a ton of people that are now interested in moving. Even though they've got a 3% rate, they're sitting on a few $100,000 in equity. They can put a sizable down payment down. Maybe their payment will go up from what they have now, but presumably those people have grown their income as well, which once again is suggested by the data on annual wage growth. So we're not making that number up either.
Right.
So I think that to answer your question, that anywhere in that 5.5 to 6 1/4 range is going to get a lot of people interested in moving.
Yeah, I feel like there's like this economic behavioral psychology where borrowers have started to really show us that they're okay with 6. Like, not, I don't like the word settled in, but they're kind of like deeming the market as in like that lower 6 seems to be the point. Because to your point, when they drop, boy, do we see applications go up on the indexes we get, but we also see a lot more contracts get accepted and a lot more transactions get taking place during that time. And that's something that I think that kind of shows exactly what you're talking about. And then add to that, that the discount points, right? We have data that suggests almost every loan at this point is getting discounts. So the consumer's conditioned to accept that discount, which would get them in the 5s. Interesting point. I think it's a great idea, a great point to the conversation. So back to that second part though, what can these borrowers do if they're looking to buy and they're locked into these rates? Like, what are some options they can do to kind of add some relief to the equation?
Well, and we'll get to the rate part. I think that if you're talking about strictly what can they do to be able to buy another home without selling their current home, right? We're still we're in a market where I think contingencies are much more widely accepted than they were. If you said the C word in 2020 or 2021, you weren't getting your offer accepted. But I think there's a lot more opportunity for contingencies. But a lot of people, it's not just that they would have to have a contingent offer. It's that they actually want to move before they sell their house.
Right.
So for those folks, I know in the height of the market, there were these programs that came out where you could buy the new home first, and these companies were offering you short-term financing with the option to then refinance after the fact, and there were all these fees and things associated with it. Really, and there's all this talk of bridge loans, right? And I think that there are probably some old school bridge loan products that still exist out there. But for the most part, if you're a real estate agent or if you're a potential home buyer, really what a bridge loan is nowadays, it's a home equity loan.
Correct.
You're taking a home equity loan on your current home and using that money to put the down payment down on the next home. So you can do home equity loans a number of different ways. Thanks for the reminder. I'll mute my computer as well. But essentially these home equity loans, these bridge loans, you can do those while your home is listed for sale, and there's no prepayment penalties on these.
Right.
So the companies doing these home equity loans know that this is a short-term loan that they're doing. And yes, you have closing costs. There will be some fees associated with that. It won't be 3% of your purchase price, which is what people were paying in some of these other situations to do some of these other, kind of niche products that came around. But I think a home equity loan is a really good option where, hey, I can support these 2 payments for 6 months or 3 months or however long it's going to take me to sell my home. Allow me to take that money, put it down on the new home, qualify for that, or get the payment that I want, get the terms that I want, and then sell my home after the fact, or even be actively engaging in selling my property. And still there's no penalties if you only have that home equity loan for a few weeks.
Yeah, and the person who wants this is the person who's got to move now. They need to take advantage of something now. It's it's one of those things that we call they're always in the market kind of buyer, whether it's unfortunate, it's a death, it's a loss of job, it's a growth of a household. There's all kinds of things that happen, but those are people that have to move right now, right? Those are the ones that would take advantage of this, because the other people, they're probably going to sit back and wait, right? They're just going to wait for those rates, wait for that moment, wait for their entry point. Yeah, they may forego some of the equity position, but they're looking to wait, right?
Right.
And then there's something that, I tend to look at here is how can you help people who are always looking to potentially readjust their payment? Because the fear is, well, if I take this home equity line out, right, and then I buy another property, I've got 2 payments going at the same time, but how do I get this higher payment down on the new home I just bought? What can I do?
Sure. Well, and it's kind of 2 different scenarios. I think if you do the home equity loan, you're accomplishing getting the lower payment initially on the new or indefinitely on the new home, right? Then you just have this other payment on the bridge loan. So you've got a first mortgage on your home, presumably, got a second mortgage bridge loan, and then you got a third,
right,
which is your new mortgage. The alternative to that is if you have the funds available to put down as little as 5% on your new home, you can go ahead and purchase that home. And then you're carrying 2 payments, right? You've got mortgage payment on your current home, mortgage payment on your new home. But then when you sell that property, you can put the rest of that money down and you can achieve the lower payment without refinancing via what's called recasting the mortgage. Basically, all that means is that the lender takes the lump sum payment that you make, and they take the new balance and they spread it out over the number of remaining months. Mm-hmm. So it's essentially as if you put that money down in the first place.
Right.
So it's a really good option if you can carry those 2 payments for a brief period of time. You want to get into the new home. You want to go ahead and move. You want to get your home ready to sell, but you don't want to miss the opportunity on the home that you want to buy. Really good opportunity to be able to do that and still ultimately arrive at the payment that you would have had you put that money down in the first place.
Yeah, and not a widely popular topic. I don't see it used a lot all the time as advertising, but it's a great option. And I think sometimes it gets overlooked in the debate of rates and affordability and structure of loan terms and, this buy down, that buy down. And, and I think as we're going to get into the second part of this conversation, because, I do love talking to you about rates, cuts, and when things are going to happen here. And I love getting your insight on that. But, there's some people that actually could take advantage of, let's say we do get one rate cut, and we're going to jump into that here in a second. They could take advantage of using the momentum of that along with potentially looking at either a permanent buy down or some sort of temporary buy down.
No, without a doubt. I think that, the permanent or the temporary buy downs, for a lot of people have kind of become, they've maybe become a little numb to it. It's a little stale.
Agreed.
And I think that that's just largely a function of the cost of negotiating those, right? Mm-hmm. If you look at the temporary buy downs, a lot of people think of the 2-1 buy down specifically, which you probably needed 2% to maybe 2.5% credit from the seller to make that work. So if you're looking in areas where there's a lot of activity, maybe you don't have the option to negotiate that with a seller. But, there's a 1-year buy down that in a lot of cases, you don't need a seller credit to be able to do a 1.0 buy down. A lot of times the lender can help to cover that cost.
Nice.
But I think it's relevant now because, we all thought the rates would be, maybe higher for a shorter window than they are. But I think that you're finally starting to see the light at the end of the tunnel of rate cuts. Mm-hmm. So I think that knowing you've got a 12-month runway of a 1% lower interest rate starts to become a lot more appealing as we get to the end of this cycle of tight monetary policy and potentially looking at the other side of 1 or 2 rate cuts this year, 2 or 3 rate cuts next year, right? And then you're looking at, okay, if I'm buying a home today, next August when my loan would go back up to the fixed rate. If I did a 1.0 buy down, the landscape of where interest rates could be at that point could be considerably better. So, just a reminder that if you're thinking about how do I get this payment down, the 2-1 buy down is going to be too expensive. The seller's not going to go for that. They sure as heck aren't going to go for a 3-2-1 buy down, right?
Right.
The 1.0 buy down is just a really good option that I don't think people talk about enough. And if rates are 6 3/4 and I can get 5 3/4 for the first year, knowing that we appear to be at the tail end of this tightening policy before we start to get rate cuts, just a really good opportunity to be able to get into a home now and be looking at refinancing possibly at the end of next year.
Yeah, and something that's an exciting topic because one of the things we're going to turn to here as we wrap up this episode is we're going to turn to interest rates cuts and what does it mean? Because to your point, lights at the end of the tunnel. And I mean, you can't turn on a news outlet right now and it's not being talked about. The rate cut is being talked about in every single major outlet, every little outlet. All mortgage professionals now are on the same page. You're seeing a lot of economists on the same page. The pundits are out there. I think for the first time, we're seeing everyone unite around this one cut, it's coming mentality. It's just, I think the question is it the next 6 weeks or the following 6 weeks? And so that's what we're going to talk about on the next episode. Guys, if you like what you're hearing, please 5-star review this podcast. Please leave us a review on there. That's really important. If you would, go subscribe to our channel. What's Your One More with number 1. Daniel, look forward to the second part. Thanks for joining us for the first one.
You got it, man.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.